Good evening, everybody. My name is Kiana Danial. I will be your host today. It is 12 p.m. here in New York, and I believe it's 5 p.m. in the Eurozone. Please give me a shout out, give me a Y for yes if you can hear me properly. We have a busy day ahead, and I would like to talk very clearly with you. So I would like to make sure that you can hear me and you can see my screen. So we have wow, we already have many attendees. We have Alexandra, Ashley, Demir, Derek, John, Honor, Zach, Zenelson, Maria, Mohammed. All right, great, everybody. And we have more people joining us today. Thank you, Zachary and Anza. Thank you, everybody, for your response. And today we are going to talk about best trading strategies for 2016. This is going to be my last webinar with Orbex in 2016. And guess what? Yesterday we had an amazing day. We had the Fed interest rate hike finally after 9 years. And the outcome was fantastic. I was trading live. We had my students and I were making them pips while before and after the Fed rate hike. There are still opportunities, so I would definitely like to jump in and cover what you can be doing for your 2016 trading strategies. And in the meantime, please definitely feel free to ask me any questions that you may have. Today's agenda is going to, well, if we have the time, I'm going to be as quick as possible. I would like to cover the economic overview of the US, Europe, New Zealand, UK, Australia, and Canada. And of course, we need to also need about oil and how that is impacting the currency markets. And having the economic points of view in mind, we are going to get into technical analysis and identifying long-term trading strategies. The reason why I would like to get into a long-term trading strategy is because we have really few trading days left in 2015, and I think it is a good time to take a look back to see what happened in 2015 and what we can expect in 2016, and should we or should we not get into a trade in 2015 and wait out for it well into 2016. So these are the things I am going to cover today. Hopefully, if you have any questions, definitely ask me. This webinar is live and I'm here to help. A little bit of an introduction of Orbex. Orbex has a huge traders library, videos, ebooks, infographics, tips and analysis. And myself appear on their web TV twice a week, and I just give a brief heads up on the economic calendar and some of my analysis for you guys to see how we are doing on over at Invest Diva. So without further ado, I'm just going to jump in. It's 12:03. Hopefully, we're gonna be able to cover everything today. So, first up, yes, yesterday the Fed decided to raise interest rates, but very small amount. It was only 0.25 basis point, which is not a small, which is not a big amount, but that is what we were expecting. One thing that we were worried about was that because of all the things that has been happening before, for example, I think I covered it in our previous webinar. If you look at the euro, 2 weeks ago, Eurozone decided to cut their interest rates. And normally what happens when you cut a country's interest rates, the market reacts badly, the currency gets weaker. But what happened at that time, the euro actually got stronger, which was very shocking for many traders. We had seen it coming. The reason why that happened was because the rate cut was not as much as people expected. And Mario Draghi had been promising that he will be doing anything that he can to stimulate the economy, but he didn't deliver, and that is the reason why euro went up. But not only that, New Zealand dollar also went up 2 weeks ago when the New Zealand the RBNZ, the Reserve Bank of New Zealand, cut their interest rates. New Zealand dollar also went up from over here, which is also shocking. So a lot of analysts were actually expecting on a rate hike yesterday, the US dollar is going to react poorly, or maybe they were thinking even if So there were a lot of different scenarios. I covered them on investdiva.com. If you are a member, definitely if you're not a member, definitely I encourage you to sign in for free. So I did have how to prepare for Fed's rate decision on the website, and how basically preparing for the worst that could come out of the Fed rate hike. And here we have the trading strategies, and they actually did work. And this scenario actually did happen, and that is what we were trading with Invest Diva students yesterday, and it was great. Basically what I'm trying to get to is that the U.S. economy yesterday, it did raise the hikes, and their tone was not as dovish as many people expected it to be, because Janet Yellen, the head of Federal Reserve, normally appears to be very, very dovish. If you don't know what the meaning of dovish is, that means she tries to be not overconfident. When you're hawkish, you're overconfident about the economy and saying the economy is going very well. So raising the interest rates basically means that, what is the outlook of the economy? This is the question for you. When the government decides to raise the interest rates, inherently it means that the economy of the government is confident in the economy. So that is the first signal. But people were thinking that Janet Yellen is going to want to balance it out in order to avoid a market chaos. After all, it is December, and December has the lowest liquidity of all across all markets, not only the forex markets, but also the stock markets. And they were thinking that she's going to say, okay, we did raise the interest rates, but this and that, and we have to still see for the next interest rate hike or something like that. But the fact is that they upgraded the economic forecasts yesterday, and that's the reason why a lot of people jumped into a bullish outlook, including myself, on the US dollar, and it has been going on. If you did not get into a bullish trade yesterday, well, first of all, I encourage you, why didn't you come up to my class at Invest Diva? But second, don't worry, we are going to get you covered. We're going to get you a strategy for 2016 for your trades to make you a lot of money. Hopefully, I'm not guaranteeing you anything. This is the forex market. Let me be clear that this is a risky market. I have to be very clear about that. Actually, I forgot to show you the disclaimer that the forex market is one of the riskiest markets in the world. And if you are not educated, and if you don't get the precautions with your account, with your margins, there is a very high risk that you're going to lose all your money. You're never going to be in debt. So that is a fortunate one of it. But definitely the education is necessary. And everything that we're saying, there is no guarantee. These are only forecasts. But what I definitely try to do is having all the odds in my favor, because it is such a risky market. The more odds you have in your favor, the better the chances that you're going to win in this market. And also, it is a game of your patience and your tolerance. How patient are you going to be, and how is your management with your psychology? It is basically a mind game as well as a investment. So we're going to cover all of that. So back to FOMC and how they upgraded the economic forecast. The FOMC published their updated forecast for growth, unemployment, and inflation, and important figures. These are all important figures that play a role in setting the timeline for their future policy decisions. Right now I'm showing you the Kiwi dollar chart just to remove the confusion for people who are joining us at the moment. I'm going to switch to this screen. So compared to their previous projections that was released back in September, the estimates show that the Fed officials are more optimistic about the growth and employment next year. And the 2016 GDP estimate was raised yesterday from 2.3% to 2.4%, which is 0.4%, 0.1% rise, but it is still a big deal because that shows confidence, additional confidence in the economy. While the ones for this year, which means 2015, 2017, and 2018 were left unchanged. The forecast for unemployment rate for next year was lowered, which means, well, less unemployment is better for the economy. It was lowered from 4.8% to 4.7%, and the estimate for this year, remaining of this year, was maintained at 5%. But on the other hand, the inflation forecast for 2016 suffered a little bit. The projection, the Fed is projecting that the inflation reading and its core version will come out in at 1.6%, which is down 0.1% from their previous 1.7% estimate. So overall, I don't want to confuse you with the numbers. Overall, the economic forecasts in the U.S. for 2016 has been upgraded, and in case you've been wondering why the U.S. dollar has been so strong, this is one of the reasons. And another reason, actually we can say that there are 4 reasons, right? So the first reason is that, well, they hiked the rates. They didn't surprise us. They have been talking about it, and they actually delivered on their promise, which was great. And second, they upgraded the economic forecast. Third, they didn't change the rate hike dot plot. So that means even with all the road bumps in the U.S. and the global economy, the policymakers in the U.S. they're still maintaining their rate hike projection, meaning that they will slowly increase the interest rates. So for this year, majority of policymakers saw interest rates being raised from 0.25%, while the committee predicts that at least 2 rate hikes will take place in 2016. And from there, the officials, Janet Yellen and her gang are seeing more gradual path of tightening moves, eventually taking borrowing costs to around 3.5% down the line, which is again a confident projection in the economy. And Janet Yellen herself, this is the 4th reason why she had a positive tone, and everybody was thinking that the U.S. dollar, even if they increase interest rates, the U.S. dollar is going to go down because everything that Janet Yellen is going to have a dovish tone, but she didn't do that. She didn't have any cautions, and she basically was not her usual self, and she basically was very optimistic about the economic outlook. So these are all very good things about the U.S. economy projections for 2016 that we may see find be ongoing all the way throughout the new year and beyond. But one thing that you do have to remember is that, yes, right now the US dollar is very bullish. The reason why I told you not to worry if you didn't get a chance to get into a bullish position on the US dollar is that it is going down across the board. You see the euro dollar is going down, which means the US dollar is very strong. Dollar Swiss is going up. I have a position on that one as well. Pound Swiss pound dollar is going down massively, rapidly. Dollar yen is going up. So these are all very bullish. But remember that what goes up must come down. And there is a very good chance that even though I got into the market yesterday at around here, for example, at dollar Swiss, at dollar yen, I have a bunch of positions open, something that I normally don't recommend, but currently, and I have been very bullish on the US dollar for over a year now, and I'm very happy that things are finally going my way. So these are great. But that I must say that after you see these are three black crows. This is a technical term for 3 strong bullish candlesticks, and after that you normally see a period of consolidation or even correction or a pullback. So I am projecting that I'm going to go over each of these currency pairs, but let's start with dollar yen because the Japanese yen is the most neutral of all the other currencies at the moment. So just to point out what the stops, limits, and pivot points for dollar yen is, our support remains at 119. It's right around here. So this is our support, and I would like to have our properties. Okay, I have my supports in purple color. so that we don't get confused. So this is the support level. And then we need to identify the pivot level. The first pivot level lies at 121.50, which is around here. I'm going to, the parameter is 121.50. This is our pivot level. These are things that you might want to write down at the moment, or if you have your Orbex platform open, definitely go ahead and mark this point out so that for future references you can take a look at them. So 121.50 is a massive pivot level at the moment. It used to be a strong resistance over here, you see, and even around here. So when I talk about a pivot level or a support level, we are not talking about the exact number. The reason why I use this number is because this level has been tested the most. The 121.50 has been tested the most, but still it is a zone. It is not this exact number. Sometimes it goes a little bit beyond it even, and it comes back up. But this zone is, in a long-term trading, is what we are looking at, just to give us an idea what to do in the next steps. And so this is our lower border of pivot, and our higher pivot line lies at 123.50, which is right around here. And I'm going to also change the properties of this one as well. Oh, sorry. Okay. Sometimes it's very hard to click on these stuff. All right, so it's around here, right? So, okay, there you go. All right. Properties, parameters, 123.50, or some analysts will actually say 64, but again, I'm talking about the zone between 123.26 and 123.65. You just average it out, and this is our level. The reason why this is a very important level is, look at this. There was a formation of a triple top over here. The triple top is a reversal pattern I have covered in the education course, and it did reverse. It went all the way down, and now it's backing up. My prediction for dollar yen, we still have to go. I need to choose another level for dollar yen, which is our resistance level. The resistance level has been setting up at 125 for a long time. And guess what? It did reach it at one point, but then it went back down. I'm going to tell you in a minute the reason why I have 125 as my resistance level. That is because of our very long-term projection. If you go back all the way, so these are the levels. This is the resistance level. Write it down, 125. We have 123.50 and 121.50 as a pivot zone, and we have 119 as the support. Now going back all the way to 2001, 1997, these are the golden times of Japan. Japan was in a very good shape. And guess what? We had the market crash. Dollar yen tested places that it had never touched before. It went all the way down to 76.25. It had never been that down, that low. And now it is trying its way back up. So what do we have here? I have said it over and over again, the markets move in cycles in the Forex market. That is not true for the stock market. That is a different thing. If you want to know about stock market, come on over to investdiva.com. We're talking about Forex at the moment. And in the long run, the Forex market moves in cycles, especially across the major pairs. The reason why is that the major pairs, the major currencies, and the major countries which involve the US dollar, euro, Swissy, pound, Canadian dollar, Australian dollar, Kiwi, and Japan, these are all interconnected, and at the end of the day, the governments want to balance out whatever happens. So that's why whatever goes down must come up, and it is coming up, and it has broken above the, you see why I chose 123.50? Because it was this level back in 2007 that the market suddenly decided to go down. So this is a previous support, previous resistance, now again turned into another resistance. right? And guess what? Before, we also had this zone over here back in 1998. So this level has been incredibly important for this market. And the fact that it is trying to break above it at the moment, then we have 125 as our second, as our support, as our, I'm sorry, resistance. The reason why is because, again, back in 2002, the market tried it. I'm being a little bit moderate over here because, yes, it did go a little bit above it, but I don't want to be too risky. It did go a little bit above it over here as well, but guess what? It used to be a support level over here. So it is also an important level that we need to keep in mind. As I said before, these prices are not strictly, okay, if I'm saying 125, that is what you have to target. We definitely want to have these numbers in our minds, but at the end of the day, we want to loosen up our stop and limit orders so that the odds are more in our favor. I'm going to talk about it in a little bit. So I just wanted to show you the long-term outlook on dollar yen and the possibilities that, because we're seeing another time, for the second time, the pair is trying to go back to 123.50. It did try it above it. It did reach 125, but it went back down. Now it's coming back probably with even more force because the U.S. is so confident in this economy. So we have the fundamentals in our back in dollar. And we have the technicals, the technical being that a break above 123.50 could open doors definitely for 125. 125 is a very, high possibility target at the moment, and furthermore, a break above 125 could even open door to 127 or even more. I don't want to go there at the moment, but the projection is, at the moment, I can say that there is a good chance that it could go up all the way to at least the highs of 2002, which is 134. Next would be over here, but that would be a little bit longer term. So at the moment, well into 2016, this is the target that I am projecting. I got into the market, as I say, over here. I am projecting that the market is going to range a little bit between 123.50 and 121.50. So at the moment, I am targeting 123.50 for a shorter term trade, by short, a medium term, let's say. I am not a day trader, let me actually say that. I am a long-term investor, and with investing, I hold my Forex positions anywhere between 2 weeks to 6 months. All right, and a medium term for me would be another, by the end of January, that I'm projecting that the market is going to go at least reach 123.50. So as I said, so the strategy for you with dollar yen, this is what you want to write down, is that you probably, if you want to make more money, you could wait. There is a chance. So these are two things that you can do. You can either get into the market right now. There is a chance that the market is going to go back down to 122 or even 121.50 and then go back up, because it is a little bit too bullish at the moment, and there is a good chance that it's going to, get tired. I call the currencies, they're dancing. They are dancing, right? These are only the couples dancing, and if they dance in one direction for a high amount of time, for a long period, chances are they might get a little bit tired. So they might get down. It might get down, and that would be a good time for us to get into the market and then target 123.50. And that is what I am shooting for right now. Again, I'm saying these. You are going to. I don't have access to all of you guys' account. I don't know what other positions you have. But I'm giving you a strategy right now. If you're not asking me any questions, you are in charge of calculating your margin. You are in charge of knowing how much leverage you're going to take and how you're going to protect your account from other points of view. The only thing that I can do on this live webinar, because it is a public webinar and I do not want to go into your accounts, is giving you some ideas. Then it is going to be your job to figure out which currency pairs you want to trade and how you're going to manage your account. And everybody is different. I'm giving you a little bit more of a long-term point of view. So that is that for dollar yen. We learned about the U.S. economy, but next, so it is not only the U.S. that is moving the markets. We also had the ECB rate cut. We talked about it briefly before, but other things that I have been looking at are New Zealand and Australian economy, as well as Canada. So we'll get back to Euro in a little bit, but for now I'd like to talk a little bit about New Zealand and how their Q3 GDP has been influencing the markets. I'm sorry here, actually the writing is not accurate. I want to talk about, well, GDP over here. So let me go ahead and correct it right here and there. Right, so we're going to talk about GDP and the overall reaction the market could have. So December, so we had the business confidence actually. We are having the business confidence for New Zealand out on a Friday, and the GDP came out better than expected. But in the meantime, even though the global growth for New Zealand was better than we thought, the Kiwi dollar has not been doing that well than yesterday after the rate hike. Let's go and check out Kiwi over here. So Kiwi dropped, and the reason why is that even though we had better than expected GDP, first of all, we had versus the US dollar, we had very strong US dollar that Kiwi couldn't keep up with the strength of the US dollar, and that is why Kiwi went down. Other things that we need to know about New Zealand is that they are doing not that bad, but not that good either. Their trade has been narrowed. Because New Zealand is an economy that relies heavily on exports, and their exports has been going down. It hasn't been as good as the government wants it to. So one of the reasons why the government in New Zealand would prefer a weaker New Zealand dollar is because of their exports, because then they can, trade balance, because then they can get more for what they get with their weaker currency. Another thing we need to look at with New Zealand is their employment. So according to the jobs report from the Statistics New Zealand, the jobless rate ticked higher. So they're from 5.9% to 6% in September, which is a second consecutive quarter of worsening unemployment levels. So this is also not a good thing for New Zealand and the Kiwi dollar. In terms of business sentiment and conditions, the manufacturing PMI was still indicating an expansion, although it was at a slower rate. So overall, I don't want to go too much into the numbers. I'm sorry, I'm just reading through the numbers over here right now. Consumer spending drastically slowing, and overall, if you look at the inflation, it has been rising in a quarter, but it has been slower than the previous quarter. So overall, the most recent data for New Zealand shows that New Zealand is doing okay because of the consumer sentiment. It's because of the consumer spending, but with the trade deficit continuing to weigh down, we had a better GDP, but then we have like lower trade, so it is kind of a mixed message. And if you look at the chart over here, you can see that it has been ranging. It has been trying to probably create a double top. So since we don't have a direct, absolute direction from the from the economic side of it, I would like to take a look at the technical analysis. And we do have a lot of questions. I'm sorry, I have been looking at it. Let me take a minute and try to answer some of your questions. Okay, as a long-term trader, for some currencies, overnight fees can be quite expensive. How can you minimize them over a long period? Let's say 3 to 4 months. How can you still make money out of it? Well, it really depends on your broker. Some brokers, I do have different brokers that I trade with, and some brokers, they only, I believe Orbex is one of them, they only make money with your spreads, so you won't have a long-term fee. It would be something like stock market that you can get it and remain in it for a long term. Therefore, you won't have to pay an extra fee for your longer term positions. And we did have another question. I would get back to you, Muhammad. I'm sorry. So we will. Let's actually. I'm going to get back to your question in a bit. All right. So going back to New Zealand, to Kiwi. Let's do a technical analysis for Kiwi again, zooming from out in. Okay, so taking a look at the long term again. The reason why this webinar is called Strategies for 2016 is because we're trying to look at the long-term strategies and use them even for short-term strategies. So if you are a short-term trader, you still need to look at the longer-term direction of the market. If you're a day trader, even if you're a scalper, I mean scalping, that we probably won't need it because you're just getting in and out. But even a day trader would need to have a general direction, general idea of what the market has been doing before getting into a day trade. All right. So here we have some levels. Let's point out the levels for QE. Okay. So first level. All right. So historically, this level has been something that QE has tapped on quite a bunch of times. Okay, let's change it to purple. And the parameter is, 60 something, 60, 50. I normally go, let's say 67, right? Is going to be purple. So this is our support level, long-term support level. The reason why is that I touched it back in 2004, I touched it again and tested it back in 2006. It broke below it in 2009, and this was a target of mine before when the market started to go down, and we did get out of the market with profit at this point, which was great, and now the market is going back up again. The reason why was the complications with Kiwi, not a direct direction with New Zealand economy. Also, don't forget that it is summer in New Zealand at the moment, so it's different than winter. Jobs are higher normally in the summer and people are shopping, so consumer spending is going to go up for Christmas. And of course their cows have more food to eat and all that. So during these months from let's say November, September, when spring starts, normally historically we've seen Kiwi going up a little bit and then it could go back down, right? So we want to see how high can Kiwi fly. So I am going to use a Fibonacci retracement level. I'm not going to go all the way down. I'm going to, let's see how it will actually differ. It seems like this one it actually doesn't matter really, so I would just keep it all the way to our support level. So Fibonacci is giving me some other ideas about the levels that I should be looking at, and it actually falls perfectly at on the levels that I have been looking at as support levels. So look how perfect this 23% Fibonacci level falls in terms of a layer of support. Because it is a pivot level, I'm going to color it orange. So we have 60 parameter. Okay, so it's 67. It says I would actually bring it down a little bit, bring it down a notch to 66. Oh, that is actually a little bit too low. So we'll bring it down to 67. All right. So again, as I said, this is a zone. When we get back to the daily, we will get more into the details of it. But this level right here has been tested a bunch of times before. It was tested back in 2010. It was tested back in 2007. Then again, back in 2005. So a pretty important level, I would say. Also, one other thing I would like to add is an Ichimoku Kinko here for this one. I forgot to add that one to dollar yen. You normally use Ichimoku because it was invented by the Japanese. We used to use it more for dollar yen, for yen crosses, but I find it as a moving average, it gives me a good idea about the market, any market anyway. So if you're not familiar with Ichimoku Kinko, this is the cloud. It's a combination of 5 different moving averages. So instead of having your MACD or a normal M&A, this gives you 5. And of course, for beginners, it makes it look a little bit too chaotic. But when you get used to it, a chart without Ichimoku actually looks naked. So here we have these lines are the cloud. Basically, what you have to know about Ichimoku is that when the market is inside the cloud, you normally would expect a sort of a consolidation. When it breaks below the cloud, you expect the market to go further down. And when it breaks above the cloud, it is again like a resistance or a pivot zone. So the cloud acts like a pivot zone. Not always, but it's good to have sometimes as an indication. But one other thing that I wanted to look at the moment was these other lines, the Kijun line and the Tenkan line, which are flattening on the monthly chart, which means on the monthly, very, very long-term point of view, the market is consolidating, even though the market is not inside the Ichimoku cloud. However, since it's below the Ichimoku cloud, chances are that we are going to see more downfalls. So this is just an indicator. If it's making you a little bit dizzy, I would go ahead and remove it if I find out how. This is how. Okay. So not only the Ichimoku cloud is giving us a short-term consolidation followed by downturn in signal. Also, we have this level, a break, and the levels that it has tested before. All right, so this cycle, what we're looking at right now is we're trying to figure out is, okay, the market went up, it completed a cycle. Is this cycle going to end right here and the market is going to reverse back up? Or is this cycle going to break below 60-70 and reach the lows of back in 2009? So that is the question at the moment. Normally we would call this a saucer top. It is in the process of making a saucer top, but it is stalling at the moment. So right now economy was a little bit mixed. Technical analysis, we have some solid downward signals on Kiwi, but we also do have some consolidation signals on a long run. So from a long run, I still would have to wait and see if I am going to target, let's say, I don't know, 0.56 right over here. I would even wait for it to see if it's going to reach 0.60. It did reach it back in May, but will it reach again? I wouldn't go too long term with Kiwi dollar at the moment because I need more evidence. So with Kiwi, I wouldn't be so long term. I would be more shorter term. And guess what? Shorter term is giving us a little bit better idea of what's going on. I was suspecting that this is going to become a double top, and it seems like I was right because look at this. The market was going down, then it started going up, and then look at this valley that may be forming. So this is this level right over here, right? It is a midterm pivot level, or basically the formation of a 2 double top over here. They do have shapes over right here, right? So yeah, so I cannot find the circles. Let's see, can I put a check sign over here? This is one top, and this could be the second top. This could be the formation of a double top. And a double top, what we're trying to say is that there are two different strategies with a double top formation. You can either, we are right now suspecting that this could be a double top, right? And so there are two strategies. The first strategy is that when you suspect that this is going to happen, you get into that position and target the neckline. The neckline, so the levels that I pointed out before were more of a long-term levels, where now we decided that the strategy for 2016 cannot be that long-term because of the reasons that I just said, but we need to be a little bit shorter term. So when you suspect that the market movement is moving within a double top pattern, the first strategy is that you can get into the market, target the neckline. Second strategy is waiting for the market to actually confirm the double top and then get into the market targeting the same size of the top of the double top, which is from 0.67 to 0.64. If it manages to go all the way down, chances are it's going to go even further down to the same amount of pips from the top to the neckline, which would bring us to around 61. So this would be the target, right? Which actually does fall. So I'll almost move the same amount. So I would, if you are going to use this strategy, waiting for the market to get to the neckline and then getting to a bearish position, 0.63 would be where I would target. So just so you know, I actually got into a Kiwi dollar bearish position right around here, and the market, because of the surprises that New Zealand brought upon us, the market went up, and I am in a losing trend at the moment. I still am waiting for the market to reverse, and it has been good to me, at least after the Fed rate hike. And with the dollar being so bullish, the projection is that there is a good chance that we can get at least to the neckline, so that we can get out of that position with no losses, right? So as a strategy, as I said, this is one thing that I recommend, but you always have to have the alternative as well. Again, I would like to add the Ichimoku cloud to see what the Ichimoku is trying to tell us. The market did break above the Ichimoku, so that is one more bullish target. So when it comes to Kiwi, unfortunately, it is a little bit of a mixed signal over here. So alternatively, so maybe a better strategy if you don't want to take any risk at all, if you don't have enough margin and you don't want to take any risk. So let me actually sum it up. We have the US dollar being bullish behind us. So that is a very, very great sign for the Kiwi dollar to being able to reach and going back down towards any of these levels. Second, we had mixed messages from New Zealand. So that is not, we want a very, very weak Kiwi. So the best pairings of currencies are always when you pair a strong currency versus a weak currency. So now we have a strong currency, which is the US dollar, which is the quote currency in Kiwi dollar. Best scenario would be if New Zealand dollar was very weak. The problem is we were projecting that Kiwi is very weak, but what happened is that after New Zealand RBNZ cut the rates, the market reacted in a very, very weird manner that we had not been prepared for. So that is the reason why we're a little bit confused when it comes to Kiwi. But at the same time, because it is versus the dollar, and dollar seems to be pretty strong and strongly dragging it down, it's still a high possibility currency in my opinion, and I definitely do have my eyes on the Kiwi after dollar yen, right? And another thing that I did want to look at today was Australia. We do have 15 minutes. I do want to get into oil as well for a little bit. So Australian economy, let's just take a look what has been going on. So the growth for Australia has been not bad. It grew by 0.9% for Q3 in 2015. The estimate was only 0.2%. So this was a great growth, but the main drag was that the drop in investments, with private investments down by 2.9% and public investments down by 9.2%, was not a very good thing. So overall, that was kind of a mixed picture. For the annual GDP, it bounced back to 2.5%. After dipping low to a 2-year low of 1.9%. Employment for Australia has been going lower. It ticked lower to 5.8% from 5.9. Is not that bad, but it's not that good either. Definitely it's not good. And so the business sentiment, the NAB business confidence for a November period improved actually 3 points. And as for consumer spending, retail trade turnover increased by 0.5% on a month-on-month, and also on a year-on-year it improved as well, but this was offset by lower retail sales in cafes and restaurants, clothing and footwear. So this also gives us a little bit of a mixed picture on that end. Inflation was up by 0.5% for Q3 in 2015, which is still lower than what they printed back in Q2. And so in summary, Australia seems to be doing kind of okay. The economy is growing in the middle of RBA's 2 to 3% range, and the inflation problem isn't as severe when compared to some other countries. So that's the reason why RBA actually decided to keep the rates on hold. And another good news for Australia is that, well, before Australia used to be very dependent on mining and commodity sectors and the exports, but the investment in non-mining industries are kind of lacking. So I'm sorry, I was just reading the thing. So so that's the reason why. I mean, we did have. Let me just back it up a little bit. Australia is very dependent historically in commodities and mining industry, and iron ore has been going down, and that was one of the reasons why that we saw like some of these dips over here. But overall, as I said, the economy is picturing a little bit of a better than expected than before. You see before, if you zoom back to the monthly, it was dropping massively. But then again, I'm going to get rid of the Ichimoku to get you less confused. These are all cycles, and what we're trying to find out is that is the cycle over. Looking at the big picture in Aussie though, possibilities of it getting really, really low is actually higher than Kiwi. So technically speaking, so so the fundamentals and the technicals are again in the long run not giving us a direct picture. Therefore, for your 2016 strategy, I would also like to get back into a shorter term trades, including this one that we are in right now. Getting into the Aussie dollar trade and range trading it between 0.7360, and I'm going to drag this down. This is our first because it seems the market sentiment is moving not that bad. I'm going to drag it back up if I could. It's not letting me. Okay. So as I said before as well, this level would be a better range trading option. So we could see the market to go hit 0.69 and then move back up. So this is a range trading strategy for Aussie dollar for the reasons that I just said. But then again, in the long run, because we have such confidence in the US economy, my longer term position, even though I won't jump on it at the moment, does remain on the bearish side with Aussie dollar as well. Okay, I hope I answered the questions. Okay, so I'm getting questions about dollar CAD. Some people are saying that they can't see the screen. I just want to make sure that if everybody can see my screen, I am gonna get into a dollar CAD. Please do give me a shout out if okay. So all right, thank you, because one of the members said that they can't see the screen. So I'm glad that you can see the screen. We're gonna get into dollar CAD in the final 10 minutes. Dollar CAD, look at that. That was crazy, and we was seeing it coming. It did surprise us a little bit before, but dollar CAD, man, oh man. So dollar, the Canadian dollar, as you know, is very, very dependent on oil prices. The lower the oil prices go, the lower goes the Canadian dollar. And this is exactly what has been happening with Canadian dollar. Oil prices have been dipping to 7 years low, and Canadian dollar is getting weaker and weaker. And guess what? Against the US dollar, it's just a massive bullet trend to the upward, which was something that we were looking at, but unfortunately, it's just been shooting back up. So if you don't have a dollar CAD position at the moment, let's again with dollar CAD take a look at what has been doing. It just went up. Oh my God, today it's been crazy. Wow. So historically, I think I covered this last time. Let's get rid of Ichimoku. If it doesn't bother you, I wouldn't mind having it. It's being a little bit difficult to get it out. Oh, this is how you get it out. Okay, you have to be very talented with this. All right, so historically, guess what happened? The dollar CAD was all the way up here, formed a double bottom, broke above the neckline, and it is going back on its reversal. Bullet train, craziness. And our next target stays at 144. Again, if you have not got into the dollar CAD, we could see after this bullet, I mean, the market sentiment is massively behind it right now because the oil prices are dropping and the US dollar is getting very strong. So we could see this bullish sentiment going on a little bit. So if you're a short-term trader, you could probably just get into the bullish sentiment right now, getting out of the market with a like smaller amounts of pips. There is a chance though, I mean, we are never going to see a bam bullish bullet train all the way up to 144. There is a very good chance the market is going to go back down to 137, 135, which would definitely be a good opportunity for the reasons that I just said. We have, well, Canadian, I'm not going to get too much into the Canadian economy, but we were thinking that it is going to even get into the recession. We found out it's not in a recession anymore, but oil prices really, really hammering it at the moment. And the projections are that the oil prices are going to remain low for at least the midterm in middle of 2016. So for a 6 months projection of Canadian dollar is actually weaker. In the meantime, we are going to see fluctuations, obviously. Yeah, that is how the markets move. So even when you see, for example, let's go back to 2008, just to give you an example, we had this massive, massive bullish candlestick all the way up to here, and then it kind of created this shadow, and then it just, you see, it went up and down, and it started ranging between this level, and then it actually went back down to form a double top. So don't get discouraged if you're feeling like you missed out on an opportunity. If you didn't get into a dollar CAD position yesterday, the market could go down, especially with the lower liquidity throughout the remaining days of 2015. So I would play it by the ear, actually. As I said, for a shorter term strategy, this is just way too many bullish candlesticks at the moment. I think at some point, any point, well, tomorrow is a Friday, or maybe next week we could see a move back down, and then resting a little bit and then shooting back up. That could be a good time to get into a bullish trade with the dollar CAD pair. In the meantime, for shorter term traders who want to know shorter term levels, these are the levels that I recommend. I do believe that the market is not going to get all the way back up. It's going to touch here and probably go lower. Let's get help from Mr. Fibonacci. We had the help before. So this level, as you can see, before the market had touched it, it is not a very strong level, but I mean, here and there, you see over here, the market had touched it before. Here, the market had touched it before. So this could be right now our new resistance level for dollar CAD, and chances are we're going to see a little bit of a range trading between this level and this level for the time being. So getting into the market at around this level would be ideal, in my opinion, for dollar CAD. So we covered many major currency pairs. Euro dollar, again, I'm bearish. We're not going to be able to get into it, unfortunately, but it is below the Ichimoku cloud. We talked about it last week. It is now inside the pivot zone. Break below 1.08 could get us all the way to 1.05. So good for you guys who got into. If you were following me on Twitter yesterday, you would have known that we got into a bearish position. We tried. Actually, my position didn't close. I'm very pissed at my provider, but that happens sometimes. So this is a projection, kind of a consolidation with a chance of bearish. The target is 1.05, and of course, as I said before, I have said it over and over again, these are just some suggestions that I'm giving out to everybody, and not all of these strategies will work for you. The strategies for each trader should and must be different. It really depends on your own trading account. I cannot see your account. I don't know how many positions you're in. I don't know what leverage you have, and I don't know your trading personality. So if you do want to get a one-on-one, I forgot to introduce myself today. I was very excited to talk to you. I'm the founder and CEO of Invest Diva. I've frequently and quoted in Wall Street Journal, Forbes, Time Magazine, and CNN. I have a book out. Definitely, if you're a beginner, go and grab it. McGraw-Hill, you can find it on Amazon. Invest Diva's Guide to Making Money in Forex. And if you do want to, and by the way, I used to live in Japan for 7 years. I'm in New York right now, and I have won a lot of awards. Blah, blah, blah about me. If you would like to get a private lesson with me to go over your account and see what type of trading is the best for you, this is one of our most popular courses. It is a little bit pricey, so at the moment we do have a 30% discount that you can find it on my Twitter account. Definitely do follow me at investdiva.com. And let's see if there are any final questions over here that we can answer. Yes, as for euro, as I said, the euro, the reason why it went up was because, I'm answering your question, Mohammed, is the reason why it went up was because the surprise that the market had to encounter, even though the Eurozone's projection is to the downside, the tools that the ECB used for stimulus wasn't satisfactory, and that's the reason why the market basically sold off the euros and took their profit, and that's why euro went up. But the overall projection is to the downside, and especially a break below 1.08 could give us a better chance of getting back to 1.05. As always, thank you so much for joining me. Here is Orbex, info@orbex.com. If you have any further questions after the webinar, I know that some people watch this webinar recorded later on. So if you have any questions, definitely do shoot us an email at info@orbex.com. Thank you so much for joining. Happy New Year. I probably won't see you here again if you don't come to over to Invest Diva. And I wish you the best in your trades in 2015 and well into 2016. Thank you so much for joining us today.